Investing your money can feel scary, especially when one day you hear that the Dow Jones is down 1,000 points and then just a few days later you hear that the markets are rallying again. It feels like an emotional roller coaster, except this roller coaster can cost you a whole lot of money if you don't know what you're doing. But not anymore. In this video, I'm going to show you how you can help bulletproof your finances by going over 5 things. Number 1 is understanding that crazy happens, especially in the stock market. Number 2, understanding how patience can help you build wealth. Number 3, talking about what do you do during a dip. Do you buy? Do you panic? Do you sell? What should you do? Number 4, talking about how do you build an investing strategy before you see crazy or dips in the market. And number 5, how do you know your money? That way you can actually build wealth. But I got to remind you that I'm just a random guy on YouTube. Okay, I'm not a financial advisor. I don't recommend what I do to anybody else. Everything that I talk about is just from my own experiences and my own mistakes. So take it with a grain of salt and never blindly trust a random guy on YouTube. And let me start by talking about number 1. What does it mean when crazy happens in the stock market? There are 2 terms that I want you to understand that help define a downward movement in the stock market, and that is correction and bear market. A correction is when the stock market falls by 10%. A bear market, what many people like to call a crash, is when you see the stock market fall by 20% or more. So correction 10%, bear market 20% or more. But this is where things get interesting. How many bear markets do you think that we saw in the stock market between 1957 to 2022? And more specifically, when I say stock market, I'm referring to the S&P 500, which is a group of the 500 largest companies in the stock market. Well, over these years, we saw 12 bear markets, meaning 12 stock market crashes. And for you money nerds, what that equates to is essentially 1 stock market crash or bear market every 5.5 years. What does that mean? Crazy happens. This is not something out of the ordinary. We know that we see stock market crashes. We know that we see stock market corrections because this happens more often than this. And so history, while it doesn't exactly repeat itself, it does rhyme. And if you understand that crazy happens, you can then understand how do you find the opportunity to make money when crazy happens, because the ironic part of this crazy happening is many people forget that crazy happens and they assume that markets will only go up. And as another reminder, on August 15th, 1971, that was when the United States dollar was taken off of the gold standard, which changed the way that our money worked forever. And because of that, this year on August 14th and 15th, I'm hosting a live investor summit. It's my biggest investing workshop of the year, where I'm going to be going over, number 1, how our money has changed over the last 5 decades, but more specifically, how you can find opportunities in today's economy to build wealth during a time where we have higher interest rates. We still have high inflation. We're seeing the slowing economy. We're seeing a change in the job market. How do you find investment opportunities? How do you find financial trends? That way you can build wealth in this changing economy. It's completely free to join. It's virtual. All you have to do is register. And if you'd like to register, I got the link for you to join down in the description below. And this brings me to part 2, patience. Let's go back in time a little bit. Take a look at the stock chart. Let's assume that you bought the S&P 500 in the year 2000, right before the big dot-com bubble bursting. Well, if you held on, you would have made your money back by 2007. And then, of course, we saw the big recession in 2008, which meant you would have saw another major market crash. But again, if you would have held on, you would have been profitable again by 2012. We know crazy happens. We've established that. And that crazy creates opportunity, but that opportunity is only there for the people that actually understand patience, because that means that you have to be able to hold on to your investments through the craziness. And during that patience, you have to stay calm, because during that craziness, people panic, they freak out, they sell. When the stock market saw this minor correction over the last week, people panicked and they freaked out, even though it wasn't that big of a dip. And this is where you have to be able to cut through the noise and continue to stay calm, as many people are losing their minds. Which then brings me to number 3, which is now, how do you actually build wealth? Because you might be thinking, well, Jaspreet, if I bought before the crash in 2000 and then I held on to 2007 and markets crashed again, that doesn't really do me any good. I mean, I have to wait a decade before I actually make any money. But you got to remember, in order for that to work, that means that you only bought in the year 2000 before the crash, but you never purchased again. And what financially savvy people are doing, and the real wealthy are doing, is when they see those downturns, they use it as an opportunity to buy. You've heard the phrase, buy the dip. Like Warren Buffett says, be fearful when others are greedy, be greedy when others are fearful. What that means is when markets are going down, you could use that as an opportunity to purchase. So if we go back to this S&P 500 chart, let's assume that you buy in the 2000 peak. But then as markets go down, you continue buying. You buy here, 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 and here on the way down. Then as markets go up, you buy here, 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 and here. You buy them on the way up. Then as markets crash again, you buy here, 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 and here. Then as they go up, you continue buying. Well, what does that mean? Now as the markets have really grown, you see that opportunity for your money to really compound and grow because you were able to use those downturns as an opportunity to purchase, maybe even buy more, maybe even buy more aggressively, because that's when stocks go on sale. So what that means is that dips, corrections, and market crashes are really only bad for two people. They're bad for the people that sell at the bottom because they panic and they freak out. And it's also bad for the people that buy only at the top. Because if you don't use those as an opportunity to buy even more, well, now you're paying top dollar, but then you don't take advantage of the discounts when they happen, and then you have to wait the longest period of time to see any return on your money. Now you might say, well, Jaspreet, what if my investment's on the way to bankruptcy? And this is where I want you to understand number 4, what is your strategy? Now again, everything that I talk about is just for example purposes. I'm not telling you what to invest in. There's 2 ways to go about investing your money in the stock market. You can invest into a fund, something like the S&P 500, or you can invest into an individual company like XYZ Corp. If you invest in the S&P 500, you're investing in the 500 largest companies in the stock market. You're essentially just investing in the stock market. Here you're investing in an individual company. Here, this company can go bankrupt, but it can also make a lot of money. So if you're investing in this company, markets are going down, it can create a good buying opportunity, assuming that this company goes back up, they continue innovating and they make more money. But if they go bankrupt, you then lose all of your money. So higher risk, higher return. This is the right way to go for some people, but for most people, this is not the right thing to do, which is why I say 98% of people should not be buying individual companies. This is reserved for 2% of people who are interested in this, who want to spend the time researching this, who want to spend the time learning about this, and who want to spend the time actually keeping up with this and have the psychology to manage this as well, because the reality is markets go up and they go down, and sometimes you'll see wild swings in the stock market. The Amazon stock fell by 90% when the 2000 dot-com bubble burst. It takes a lot of patience and a lot of strong psychology belief to hold on to a stock when you see it go down by 90% and not know if it's going to go back up. So it takes a lot of understanding of the fundamentals of investing if you want to be investing in individual companies, especially when things go down. The alternative is you can invest in a fund like the S&P 500. Now, the interesting thing about this is XYZ Corp might be one of the companies in the S&P 500. And if XYZ Corp goes bankrupt, well, then it'll get kicked out of this fund and be replaced by somebody else. So your risk is a little bit lower, but your upside is also a little bit lower as well. But now, when you look for opportunities, it's a little bit easier, less time intensive, less work, less risk. And now, when you see markets go down, it could be an opportunity for you just to invest your money into the stock market. This is one way to do that. There are funds that give you exposure to the S&P 500. For example, if you invest in SPY, this is a ticker symbol of an ETF that gives you exposure to the S&P 500. Not telling you what to invest in, just an example. You could also invest in a ticker symbol like VTI. If you invest in the VTI fund, this will give you exposure to the total stock market. So now, if you know what it is that you want to invest in, it's a little bit easier because when you see downturns, they create opportunities. Now, of course, there's the chance that markets will never go back up. Then you lose money. But if you believe in the future of the American economy, if you believe that the stock market's going to continue to rally in 5 years or 10 years or 20 years, well, then it creates a good buying opportunity because that means you can buy a piece of the economy while it's on sale. So you have to understand what it is that you're investing in. And if you believe in the future of the economy, down days create opportunities. This is why I say recessions and market crashes create more millionaires than any other time, because they create opportunities for you to come in. If you're financially savvy, if you're patient, and you're prepared, meaning you have cash, you can then come in and purchase some of these investments at a huge discounted price. But you have to know your strategy, and this is something you want to be thinking about before you see a downturn in the economy. Now, I also want to say this. We know the markets go up and down, but you don't have to wait for a down day to start your investing journey. What Warren Buffett says, one of the greatest investors of all time, is that time in the markets beats time in the markets. People who time the market end up missing the bottom, and then they end up selling too late. And the reason why is because when markets are go down, you always think that it's going to go down a little bit more. And you're waiting for that perfect time to come in and buy. and then you miss it and it starts to go up, and now you say it's too expensive. And then 6 months go by, you wish you would have bought it when you thought it was too expensive because now it's way more expensive. And then another 6 months go by, and then you wish you would have bought it 6 months ago. That's the common trend. It's the same thing when it comes to selling. Every time you think about selling, you think, well, what if the stock goes up just another 5%? Then I'll sell. And you're waiting for that perfect opportunity, and that's why so many people end up losing, because you're trying to perfectly time the top, you're perfectly trying to time the bottom, and you end up missing. When you're investing into funds like this, one of the simplest things that you can do is set up an automatic investing strategy. It's called dollar cost averaging, where now every week or every 2 weeks or every month, you're just passively investing your money into these funds. It's automatic, it's consistent, it's passive, you don't got to worry about it, and it happens on autopilot. The only thing you change now is when markets go down, you can invest a little bit more aggressively. That way you can accumulate more shares of something that you believe in for the long term. And it's got to be something that you believe in, because if you don't believe in it, why are you investing in it in the first place? Just because a random person on the internet said so? Not a very good reason. Do your own research, do your own due diligence, and only invest in things that you personally believe in and are willing to lose money on. Which brings me to point number 5, which is understanding your finances when it comes to investing. What I learned over this last week and a half is that many people have turned their stock brokerage into a separate checkings account. That you put some money in here, and you're hoping that by next week, you'll be able to turn your $1,000 into $1,020, so you have a little bit extra money to pay for your expenses. And that is not what you want to do with your stock market portfolio, or really any investing portfolio. Your investment portfolio is separate than your spending money. Okay, you got to have savings money, you got to have investment money, and you got to have spending money. Separate these things. Create separate accounts, separate bank accounts for each one of these things, and treat them very differently. Your investment money is something that you got to be able to let go of. Do not invest money that you're not willing to lose. If you need that money next week, if you need that money next month, don't put it in the stock market. When you invest your money, whether it's the stock market, whether it's real estate, whether it's startups, whether it's gold, whether it's cryptocurrency, I don't care what you're investing in. If you're going to be investing that money, you got to understand you're parting ways with that money for years, if not decades. That's the mindset that you got to have, that your money actually has time to grow. Remember, part 1, crazy happens. We know that crazy is a part of the market. If crazy is a part of the market, you got to be able to adjust that into your portfolio. So if crazy happens, you got to let crazy happen and adjust for that. Allow time for the crazy to happen, because if you have time ahead of you, if you're in your 20s, if you're in your 30s, if you're in your 40s, even if you're in your 50s, you got time ahead of you. Let the markets do their thing. And if you're not planning on touching the money for 5 years or 10 years or 15 years or 20 years or 30 years, why are you freaking out over what's happening over the course of a week? Especially if you continue to believe in the economy that you're investing in. If you don't believe in the economy that you're investing in, if you think the American economy is going to collapse, why are you investing in the stock market in the first place? So you're investing in stocks because you believe in the American economy. And if you believe in the American economy and you're investing for the long term, which is more than 6 months, why are you freaking out when something happens over the course of a day, a week, a month, even a year? Let the markets do their thing. Use the crazy as an opportunity. If you're investing in good assets, do your financial education, be prepared, pay attention to financial trends. That way you can find the opportunity, and use the craziness as an opportunity to build more wealth, not to build more fear and panic. Sure, you got a 600% increase in incomes over the last 50 years, but the prices of things that you need have gone up significantly faster than that. Back in 1971, the median household income was based off of one person's income. In 2023, most households were a 2-income household. So you double the number of people working, but most people still aren't able to keep up with the price growth of things.